For years, I tried to look for the secret sauce of trading. I tried every indicator out there: MACD, RSI, CCI, stochastic, Bollinger Bands, EMA, you name it. But in an intraday basis, I couldn't find something that will give me the confidence and the edge that I was looking for. Actually, they hurt my psychology because I couldn't understand their limitations. In this video, I will tell you why I don't use them, why they are lagging by design, and I will tell you the one and only indicators that I have in my charts that has given me the edge that I was looking for. Let's jump right in. I want to talk about one of the most popular indicators that traders are using nowadays is the MACD, Moving Average Convergence Divergence. Why I don't use it, why I think it's a nonsense for an intraday trading. And the way this works is that the MACD is composed by three main elements: the MACD line, which is the blue line here, the signal, which is the yellow one, and the histogram. So the MACD is created out of a difference from two EMAs. I have plotted the EMAs here in the chart. In this case, I have the 12 and the 26. You can customize these numbers to your advantage. You can optimize, you can change them, see if you find a better edge, but this is the default numbers that every platform has when you add the indicator to your chart. The way this blue line is created, the MACD line, is the difference between the blue and the red here. Every time the blue is above the red, the MACD is on a positive side here, above zero. For instance, here you have a crossover to the upside and you have the blue line here crossing zero. Now, every time the blue line, which is a 12-period EMA, is below the 26-period EMA, quote unquote, in a downtrend, this MACD line should be below zero. You see here, crossover here, and this thing is crossing below, right? There you have a level of lagging. So price action is being created, and the EMA has to wait for the candle to close to have an accurate read. So when the candle closes, right, this thing is printed. So that's one level of lagging. Then you have the second component, which is the yellow line, which is called the signal, and it's not more than a softening line off of the MACD line, which is a 9-period EMA. So the yellow line is a 9-period EMA of the MACD line. There you go. You have a second level of lagging. You have an EMA of a line that is created out of an EMA. And then you have the third element is the histogram, which is just the difference between the MACD line and the signal line. And you can see how every time a candle closes, so here's the thing. You need to wait for the candle to close to have an accurate read. If the candle does not close, this thing can be fluctuating along with price action. So you can not have a accurate read of what is happening in the market, because you need to wait for this candle to close. So here you have the difference between the blue line and the yellow line, and that is what is plotted in these bars. Every time the blue line crosses over the signal line, it goes to the negative side, meaning every time the MACD is above the yellow, you have a positive histogram, and every time the MACD is below the yellow, you have a negative histogram. So there are many ways that I found online. Traders use this thing, so you can have divergences. You can see crossovers on the MACD and the signal. I am not going to discuss the way people trade this, and if you can find an edge here, I think you should use it. I have nothing against the indicator. It didn't work for me on an intraday basis. I think you can have very misleading signals, and psychologically it was very hard for me to understand the limitations of the indicator. That's, I think, is a key element that you need to take care of. You need to understand that the indicators has a lot of limitations. For my type of trading, I don't think is a good tool. Now, I bet there are some traders that can use it, but it didn't work for my own style. Now, what I want to talk about is an indicator that I do use that I think is very useful and is not lagging. And I'm talking about volume. So the only indicators that I use in my charts are very clean, but the only indicators that I do use in my charts is volume. And volume does not have that same lagging nature of any other indicators, like we saw with the MACD. That's a matter of fact is that as volume comes in, price action is developed in the chart. So volume is a very good indication of what the market wants to do. And also on an intraday basis, how I use it and give you a very good buy or sell signal. I use volume mainly in three ways. I do a horizontal volume, By the way, if you don't know how to use horizontal volume, I will leave you a video here so you can learn how I choose my zones using horizontal volume. I use vertical volume, and I use the footprint. Footprint is just the order flow of volume coming into the market. Let's talk about order flow first. And it's not complicated. How I read this is pretty simple, but I have found an edge very, very useful. It's not lagging, and also I am trading on an intraday basis, and you need to be fast reading the market. The example that I'm going to show, you can see how the market is dropping since the open, and you have a sort of like a downtrend on the first half hour of trading, and you can see how the market is dropping here, and you can pay attention to this candle, right? Now this candle has a higher volume than normal, so all these volumes are like 5,000, 6,000. This one is 7,300. It's a little bit higher, so you can see a little bit of exhaustion there from the seller's side, and it has minus 1,400 delta. Okay, it's a high number of sell orders against the volume of the candle. The very next candle, a little bit lighter volume, 6,400, but then you have a minus 500 delta. But you can see here how the candle is green. So one of the things that I pay attention now is how orders are coming in, and if they have follow through. What does this mean? If we have a bunch of sellers here and prices does not go to the downside, these sellers are going to have to at some point to bail out their position, and that creates a force in the opposite direction, right? Because if you're a seller, if you short sell a contract, how you cover your contract? You have to rebuy it, right? So that could create a force against the direction that they want price to go. Right, so the very next candle, minus 500 and a green candle. So there you go. You don't have follow through there. The next candle is close to 161 positive delta, and the candle is green, but it's more like a neutral candle in both sense, the nature of the price action and on volume. Then the next candle is minus 200 delta and very neutral candle. But you see how prices starts to go up. Right, price starts to go up until we have this high volume buying candle right here. Very high volume, very high delta. After this candle, you start seeing that two things might be happening in the market. Number one, short sellers are bailing out, or a bunch of buyers are just coming into the market, are being attracted to the market. After this candle, prices starts to retrace to this level, and what it gets my attention is that in here, we did have a bunch of sellers, minus 1,400 delta, and we didn't have follow through, right? So prices came into this level, and look what happened here. On a 7,000 volume, meaning seller exhausted again, because we didn't have follow through. And we did have minus 900 delta at some point, and buyers pushed this thing to the upside until we had a minus 70 delta. The fact that we had minus 900 delta at some point, and now we close very neutral, and having this green candle tells me that these sellers that were here, accumulating, are now covering their position. They don't believe the market is going to go down. And then after this candle, you get that signal from minus 900 to neutral to like minus 70 delta, and then you can actually assume that buyers are going to step in, or are stepping in this market very aggressively. And what you can see is how prices moved to the upside for the rest of the day. Okay, so that's one of the way I see volume through the order flow or footprint chart. The second way is I use horizontal volume, right? Horizontal volume is very, very good to see where market is creating value. For instance, you have this day right here, and these all are very cherry-picked examples, so you can understand how this thing works. The market is a little bit more messy when you're trading. You will probably don't see it as clear, but with practice, you can train your eye to start seeing these type of things. So you have volume right here. You can see how value is created here. And the way I draw this thing is Control-3 on the NinjaTrader chart. And then this is one day. This is the second day. You can see how volume migrated from here, from 16 to 53. It's almost 1% up. So the following day, you have this. Now you look at this. So migrating, volume is migrating from 16 to 54, now to 99. So now you have a jump. Now you can see how buyers are clearly in control here. Now on the following day, you can see how the market gapped up, and after the open, it started to go down. And one might think that this is a bearish day, but if you plot the volume profile, you can see how value was created above the previous day. Even though we dipped temporarily below 99, we managed to have the majority of the volume right here around 13. Okay, so here you can see how buyers are being in control. Now, how do you trade this? And there is where I use different things. I could use a high volume node. So just plotting high volume node in these 4 days is not what I do. Is futile because you have sort of like a trending week, but you need a balance area. Since we don't have a balance area, if you don't know how to choose zones, I have a video here. I'm going to leave you the video right here and a link down below so you can see how I draw my supply and demand areas. But one of the things that I use is vertical volume. So the way I use vertical volume, just get rid of that, is that when you have a launching point, when you have directional conviction. What is directional conviction? It's when you have solid candles to one direction with volume, meaning this is the direction for the day. There is no point of discussion. The market is moving either up aggressively or down aggressively. Those are launching points, right? So you can see how this candle opens at 9:30 and this one opens at 10. For 1 hour, the market just moved down with no retracement or non-stop with a lot of volume. Here you see how at the open is one of the highest volume during the trading session. So you can see how these buyers are in control again. You have horizontal volume telling you is that buyers are in control. Now you have this. So where are you trading this? Well, launching points is one of the ways I find areas where to trade. You can draw a line here or go to area right here, right? And where the market came back is to this area. Boom. And you can go on a lower time frame to try to find formations or a sideways market right here and try to see if you have some sort of demand here. But when prices came here, you know that value is perceived higher. And when we came back here, we spent very little time and we reject this area. And right after that, the market continued to the upside. Those are the 3 ways I use volume. It's not lagging. It's actually very accurate because as volume is coming in, price is being developed in the asset. So I think is the best way to have an extra indication on top of price action to see what is happening in the market. Yeah, I'm gonna close this video. If you like it, if you find value, please give us a thumbs up and consider subscribing to the channel so we can create more content and keep growing and reaching more traders. See you in the next one. Bye.